Hello smart money traders, this is the third video of the 5 most important institutional reference point. In the last 2 videos, I took our time to explain the first in their order of importance. Remember, I mentioned that we're looking about only the 5 out of the 7 institutional reference points as taught by ICT. We're looking at first the mitigation block, then the breaker block, then the liquidity void, then the fair value gap, then the other blocks, then the rejection blocks, and the old highs and the old lows. Okay, if this is the first time you are coming across my YouTube handle, this is a very good time for you to click the subscription button so you stay updated with every video that comes on this YouTube channel. I can guarantee you that you're going to find a lot of insightful lessons across my content. Okay, so today let's talk about the third institutional reference point. In its order of importance, today we are talking about the liquidity void. Now, a lot of people get confused when identifying liquidity void, but it's not really that hard to do. Liquidity void is very simple to identify. So what is a liquidity void? Liquidity void is an area in price action where there is only one-sided price delivery. For example, if we see price action create sell, 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 price action has been selling and without any opposing buy candle, that is a liquidity void. This is just a type of liquidity void. When we see price action selling and only the sell candles without an opposing price action, that is liquidity void. Then when we see price action creating buy candles, buy candles, buy candles, only buy candles without an opposing sell candle, that is also a liquidity void. Liquidity voids are inefficiency in price action that institutions would usually want to rebalance before taking the next long move. They would like to rebalance the previous inefficiency that was created in price action. Again, another type of liquidity void is when we see price action opening gaps. All right, price action opening gaps during the new week opening gaps, the new day open gap. That also is called a liquidity void, even though it has a specific type of void. Sometimes we call them vacuum gaps, vacuum blocks, vacuum gaps. We call them vacuum blocks and vacuum gaps. They are also inefficiency in price action. So remember, in order of importance, when we look for mitigation blocks and it's not there, the breaker is the next to look for. In the absence of a breaker, we look for liquidity void. And let me show you in charts exactly what liquidity void, a simple example of a liquidity void. Now, most times when liquidity voids are created, institutions would like to trade back into that void before the next longer move. For example, we're looking at the dollar index 1 hour time frame. This is price action created structure bearish, taking out the high and created a shifting market structure bearish. All right, right there, price action created that expansion lower, and we see that long candle that gave us a one-sided price delivery. That is actually liquidity void. Institutions would like to rebalance this either by 50% or by completely rebalancing the inefficiency before the next move. And of course, you see what price action has done. Price action traded into that void. And when you look at the void also, let's outline the gap there, the fair value gap right there. With that, this is called the sell side imbalance, buy side inefficiency. It's a type of liquidity void that price action has just created. Do you see how price traded back into it and created the next expansion lower? Again, look at another void right here. One-sided price delivery without an opposing price action. You see that liquidity void. Price action traded back into that void, mitigated the void with about 50% before the next expansion lower. So liquidity voids are technically draw on liquidity. They serve as the draw on liquidity when you are looking at price action trading into internal range. They serve as draw on liquidity. Okay, they serve as the draw on liquidity. Now let me show you another one here. Price action created that shift of structure right here. Okay, shift of structure bullish, but did you notice we had one-sided price delivery right there? That is liquidity void, which was mitigated right here. Price action traded back into that that gap right there. This is actually called the vacuum gap, and also I think this is also the Monday opening gap. So we like to measure 50% of that gap, and 50% of the gap is called consequent encroachment. Price action would mitigate 50% of the gap. You use the Fibonacci tool, measure 50% of the gap, and let's see what 50% looks like. Alright, so 50% of that gap is called the consequent encroachment. Do you see the precision in price action rebalancing that gap there before the next expansion higher? Again, this is another time where we see price action create a one-sided price delivery, that gap right there. Another new week opening gap on Monday, right? Price action rebalanced it, as you can see there. So every time you see there's an underlying gap below, don't be too quick to take a buy, knowing truly that there's a gap below, because that gap is also serving as the drawn liquidity. It's serving as the drawn liquidity. Look at another area in price action here. When we see price action created one-sided price delivery, that is liquidity void. You see that most people will be eager to sell from here, but if you are patient enough, you'd see price action mitigated that inefficiency in price action before the next expansion lower. Again and again and again and again, you'd see these things print out in the charts because they are significant institutional reference points. Look at another area where we have price action create one-sided price delivery. Did you see that price action rebalance that inefficiency there? You see that created another inefficiency here, traded up, retap into it, and created the next expansion. So this is how we look at liquidity void. We are looking at liquidity void as drawn liquidity. A simple way to identify the next drawn liquidity, especially when you are trading, is identify also the next liquidity void residing either above the market. That will serve as the buy sell liquidity. That will serve as the drawn liquidity residing above the old highs, because we have a liquidity void residing the highs. And if we are selling, we should identify the liquidity void in price action. Price action will want to rebalance the inefficiency before the next big move. Let me know if you enjoyed this video, and let me know if you learned something. Don't forget, join the Telegram community using the link on the description of this video for free educational content, free trading signals. And those of you who want to join me on one-on-one mentorship, reach out to the link on the description of the video, and my personal assistant is going to put you through on how to join me on the one-on-one mentorship. My friends, let's call it a day. Until next time, I wish you good luck, good trading, stay safe.